In local government, there are three financing structures or mechanisms that are commonly used for project financing. These mechanisms are financial leverage, blended finance, and co-finance. We will now take a closer look at each of these structures. The first financing mechanism we will look at is financial leverage. When municipalities leverage finance, they usually take a small amount of capital and use it to unlock additional sources of finance. Typical examples of financial leverage from a personal or business perspective could be a family using a deposit as leverage for a home loan, or a business using cash on hand as leverage to boost purchasing power on assets. It is important to note that leveraging municipal finance with private capital does carry risk. For example, large infrastructure projects tend to take more than a year to complete, and in the event of an economic downturn, interest rates are likely to fluctuate. The cost of financing infrastructure through debt can increase substantially if interest rates increase, which in turn may lead to default payments. When looking at financial leverage, it is therefore important to consider the scope of the project, the timeline, and the potential risk. The second financing mechanism we'll look at is blended finance. Blended finance is a mechanism that uses capital from either a government or philanthropic entity to catalyze or unlock private sector investment. It often combines concessional finance, which are loans that have been given on more generous terms, and private sector financing. Blended finance is one of several tools to mitigate risk and facilitate financing for private sector-led projects that have the potential to generate social benefits. This type of finance can also yield positive results for both private sector financiers and beneficiaries. It has emerged as one of the tools for addressing risk and encouraging private investments that can transform people's lives and contribute towards climate action. A good example of blended finance in South Africa is if government is looking to invest in a special economic zone. It could provide industrial land at reduced rates to companies manufacturing green technologies. Municipalities that are well positioned for more investments by the private sector, such as metros and large secondary cities, are encouraged to take a blended finance approach. The third financing mechanism we'll look at is co-finance. Co-financing is when two or more lenders agree to finance a single project or intervention simultaneously. This mechanism often provides any additional funding required to fully meet the financing requirements of large projects or programs. In South Africa, co-financing is typically the approach used to finance large-scale infrastructure projects as it improves speed and quality of delivery. This financing mechanism can have different terms for different periods in the project cycle. This ultimately reduces the risk on a single financer. All these financing mechanisms have a variety of benefits. They offer useful ways of diversifying sources of finance and targeting municipal spending to attract additional finance from the private sector. They also help share risk with the private sector. The main benefit of diversifying sources is that if funding or financing from any single source dries up, other sources can be sought to maintain operations and prevent projects from stalling or failing.